Hello, and also hello. On this channel, we normally open with some comedy, some humor to break the tension before we get into the nitty-gritty. And today is no different. Enjoy.
And some individual names that you like right now and have actually been putting money in right now include Upstart, that is one, Tesla, MGM, and AIG. Why those four, all of which you've bought within, well, basically this week, except Tesla, end of last month?
Yeah, so Upstart's up about 25% just in 4 days since we bought it. We bought it on about 4 days ago. So that's actually made a nice little move in the short term, probably a little extended right now, but longer term, that's a good looking name. Very powerful, very strong earnings. These stocks are acting.
What do they do?
Really
I don't even know them. What do they do?
Excuse me?
What does Upstart do?
Well, I'm sorry.
What kind of company is it?
Yeah, I'm not. You're breaking up.
Oh, well, I guess we've got an audio problem there, Mark. I'm sorry.
Welcome, everybody, to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and what a green day. Led by the broader market, US stocks were higher after we had some very upbeat earnings from Morgan Stanley and United Airlines on the back of yesterday's ASML technology-fueled slide. But we did see Nvidia and semiconductors somewhat pair those gains, mostly just Nvidia. Still a lot of anxiety in the semiconductor space after ASML's earnings, but Nvidia really should be okay regardless. We saw underperformance in the major names, Microsoft, Apple, Google, Meta, Amazon, the big names that led the rally for the better part of the last 18 months didn't participate. We saw broad-based gains pretty much everywhere else, except in some of the defensive sectors, stuff like the defensive components of healthcare, as well as consumer defensives, consumer staples. All in all, a very green day, a very positive day, led by financials, led by utilities, energy, real estate, industrials. It was green. And what really helped fuel the rally today was some earnings. United Airlines came out. They were up 14% today. Very strong momentum. They posted earnings of $3.33 per share for the third quarter, topping Wall Street's estimates of $3.07. A huge beat. They also beat on revenue of $14.84 billion. The market was expecting $14.72 billion. United Airlines also announced $1.5 billion worth of shares, and that's why the stock was up 14% today. And United Airlines earnings actually fueled the broader airlines market, and we saw a nice pop in the airline stocks today, and I think this is going to continue for the rest of the quarter. Upbeat earnings tends to do really well into the next quarter, and so you should see price action maybe consolidate over the next couple of days, but then continue making higher highs into the next quarter earnings. Another huge day for Morgan Stanley, up 6.86% for the day, and the stock reported a large year-over-year increase across a variety of metrics in its third quarter earnings release. Profits jumped compared to last year thanks to a rise in deal making. Morgan Stanley also came out and said it expects the IPO market to bounce back next year in 2025 and continue into 2026. That's very, very positive, especially in this bull market. Fees from investment banking jumped 56% from a year ago, and this brought life back to financials, which was the second best performing sector today, right behind utilities, which was bouncing back from yesterday's slide. Financials were up 1.18% on the day, followed by XLRE, real estate or REITs, because yields did come down today. Those were the best performing sectors. The S&P 500 gained 0.44%. It was weighed down by underperformance in technology as well as comm services, which was up 0.24% and down 0.09%, and also weighed by healthcare as well as staples. And if we look at the worst performing sectors today and those that underperformed the SPY, it was largely the tech space as well as the defensive space, healthcare and staples. And for those of you that don't know, in the XLC, a large component component of that sector is actually a defensive sector. Stuff like telecom services are seen as defensives. So pretty much what we saw today was technology and defensive sectors by utilities underperform the market, and then cyclicals, sensitives outperform. And we just saw a broad-based rally, a broad-based gain in large caps, especially in small caps as well. Mid caps, we saw small cap value up 1.56% today. The Russell gained very strong, but we also saw outperformance in small cap core as well as small cap growth. Mid caps outperformed as well, especially in the value and core segment, and large size did gain today, but not as much as mid caps or small caps. And that's because we saw the bigger names, the Magnificent Seven names, weigh on the large size segment overall. But looking at market breadth, for a long time, guys, this current bull market was defined by those Magnificent Seven stocks driving averages longer. That is literally no longer the case. We're actually seeing one of the most widespread rallies to new all-time highs in this current rally. Today marked the strongest net percentage of stocks hitting new 52-week highs in a single trading session since March 2021. And we know how strong 2021 was. In the New York Stock Exchange, 187 new 52-week highs, 12 new 52-week lows. That is wild. In the NASDAQ 100, 170 new 52-week highs. Absolutely crazy. 81% of stocks advancing today in the NYSE. In the NASDAQ, 71% of stocks advancing. Very, very strong. And you also have to understand that here in the NASDAQ, there's a ton of just like unprofitable tech companies, financial companies, biotech companies. And that's why we tend to see more stocks declining. But when you look at the New York Stock Exchange, this is very, very strong market breadth. And if we actually go to the moving averages, we see much the same. Look at the 5-day and 20-day, the shorter term moving averages. 72% of stocks above their 5-day, 67% of stocks above their 20-day. We all know what happens. It starts with the shorter term averages and moves its way into the midterm averages. Right now, the 50-day and 100-day sitting at 69 and 66%, and then to the longer term moving averages. And this is telling us that we can actually see more of a broadening out in the market, and we can actually see the longer term averages improve, even though this right here is still very, very healthy and robust levels. 61% of stocks above their 200-day moving average, 69% above their 50-day. That is robust market momentum. And this was coming off the lows we saw last week as well as yesterday. So very strong market breadth and market momentum today. You don't really want to fight the trend in this environment. In this environment, investors get rewarded for holding equities. And looking at the chart today, we saw some very interesting developments in the commodity markets. We got a high impact news event. Donald Trump came out and talked about tariffs and what that's going to look like in his presidency. And because of that fresh tariff news in the back of investors' minds, gold, commodities, and silver was up 0.44 and 0.68% respectively. And today, we also saw the dollar rise. And generally speaking, gold will rise and the dollar will rise when we have talk about tariffs and international sanctions. Yields will also rise because of inflation concerns and a slowdown in the economy, but that didn't happen today. Yields actually fell, and that's what supported the small cap rally today. And the IWM, guys, very, very interesting. This is a new 52-week closing high, not a wick high, but a closing high, and we closed at the highs of the day. If we go to the 1-year chart, you can clearly see we closed at 52-week highs. Very, very bullish. We also saw the core resistance, the put support, and the gamma flip all move up. The gamma flip now at 22.40. It was at 22.15 just yesterday, which means if we do pull back, we can then find support on a technical basis. This would mean another higher low at the gamma flip zone, and then we can go target the core resistance, or we could just move up from here. Regardless, small caps looking very, very strong. And if we actually go ahead and take out this high, that's even better. Hopefully we go ahead and do that tomorrow. We are seeing again outperformance today in the IWM as well as in extended hours. That's what you like to see. Relative strength in small caps, and I think it's going to continue into the end of the year, as well as in stuff like the RSP. Strong day for the RSP, strong day for mid caps. They look very, very strong, and they closed at all-time highs, not 52-week highs. The RSP and mid caps had closes at new all-time highs today. Not quite wick highs, but closing at new all-time highs, and that's exactly what you want to see in a bull market. And again, I think this is going to continue into the end of the year. Looking at the S&P 500 now, the put support did move up today from the 56.65 area to the 56.75. We saw the same move up 10 points in the gamma flip zone, but the 59.05 core resistance stayed where it is. So we did see a very bullish candle here today, and that means we could probably see more market momentum. I think if we go ahead and take out these highs we made in the last couple of days, that should open the 5900 area. However, if we do pull back, look for support here at the gamma flip, and then we should go ahead and hit that core resistance zone, guys. But you want to buy dips very, very quickly, because all dips are getting bought very quickly in this market. Looking at the Nasdaq 100, guys, so we did go ahead and break this high, but what we want to see now is we want to hold this low and continue the move up. If we don't hold this low, this is going to look like a lower high relative to the new all-time high we set here in the month of July. However, if we go ahead, let's say we pull back, find support somewhere in this area, and then move higher, break all-time highs, that would be constructive. But bulls did come in a very big way today at the lows, and while the Nasdaq 100 was flat, we actually saw a lot of buying. If we hop on the 5-minute chart, look at what we did today. We had a huge slide in the early hours trade, found support, put in a bottom, and then we sort of made higher highs into the end of the day, marking pretty much a flat day for the Nasdaq 100. However, I think in positive gamma, we want to buy the dips, sell rips, but we do want to stay cautious because we did slip into negative gamma ever so slightly, but bulls did come in and buy the dip. What I really want to see is just a break of these all-time highs. That's really what I want to see, a break of those highs, and then we can maybe like pull back, and then we can continue the rally into the end of the year, because right now with a lower high relative to these highs, it doesn't look that constructive for the Nasdaq 100. However, we are in positive gamma across all of the major indices, and that means we buy dips, sell rips, guys, until we actually hit the core resistance. Then we could look for some sell side, but until we actually hit those upper bounds of the resistance zones, you really want to lean long. And this market is definitely rewarding investors for holding. Guys, if you don't want to put your money into stuff like the S&P 500, the Nasdaq 100, as well as mid caps or the RSP, definitely look at some ETFs, stuff like the TARF, the PACER small cap cash cows, pretty much a small cap quality ETF. It was up 1.38% today. It's performed very, very well. Another place is XSHQ, small cap quality ETF. It was up 1.34% today. Stuff like the MOAT index, MOAT, wide mode companies trading at a discount to their fair value. The composition of about 50 companies, very strong market beating returns. It's outperformed the S&P 500 in the last 10 years. Very, very good ETF. I really like this ETF. And if you're looking for individual stock names, look at PayPal. It was up 1.6% today. Very strong gains. And even look at stuff like Paycom. Didn't do too well today. It was down 0.82% today, but very, very strong, healthy returns. And it looks like we are forming like a higher low relative to these lows we made in the stock. And all we need to go do now is break these highs, and we should have trend continuation. I do think this name is going to perform very, very well over the next 5 or so years, and a great place to buy, in my opinion. So those are names that I'm looking at right now. If you do want to get into the Magnificent 7 names, look at stuff like Alphabet or Google. It's the cheapest Mag 7, and I think once it brushes off a lot of the antitrust concerns, I think we're really going to see a monstrous move to the upside, back to the all-time highs it made in July. I mean, for the most of this year, Google was trading really, really well. It was just after the earnings and then the antitrust news, we saw a huge pullback. We found a bottom. However, we're doing a bit of price discovery here at the 164 to 170 level. All in all, robust price action. I do see Google taking out its new all-time highs. Maybe not before the end of the year, but definitely in 2025. And looking at gold, even though we did go notch somewhat of an equal high, I still think we're in this trading range, and I do expect us to do this for the rest of 2024, and then in 2025 go up, break those highs, and then go hit the $3,000 mark. That is my price target in the first couple of quarters of 2025. I think we see 3,000 gold. And for silver, I'm very bullish on silver. I think we're going to see a $60 price target in silver towards the end of 2025. All in all, guys, you want to hold equities. You want to be diversified a little bit into commodities as well. And if you want to get into bonds, I think now is a great time, especially in stuff like TLT. I think this is going to go back to the highs we made here at 102, 101. So great place to put your cash, collect some yield if you really want, and have some upside momentum too, especially as we go into rate cuts. We're about 2 or 3 weeks away from the next FOMC, and depending on if we get a rate cut there and the outlook for December and January's FOMC, we could see further upside in TLT bonds. Generally speaking, guys, bonds perform really, really well in rate cutting cycles, and that's what we are in right now. However, in equities, guys, buy any dips you see. Stocks look really, really, really good and are poised to go higher into year end. Let's talk about sentiment. This is CNN's Fear and Greed Index, and right now we are in greed territory. Guys, stocks are at all-time highs, and in that type of environment, we are going to see greed in these sentiment and breadth indicators. I'm very surprised we're not at extreme greed, but that's because a lot of these like Magnificent Seven companies aren't at all-time highs. We're seeing the broader market at all-time highs, near all-time highs, and some of the Mag 7 names at all-time highs. Meta and Nvidia are, but stuff like Google not quite there, and that's why sentiment is, while still very positive, in greed territory, not quite at extreme greed. However, in an environment like this, you want to hold equities because it generally means stocks move up and to the right. And the S&P 500 trend environment, measured by whether the 200-day moving average is rising or falling, continues to be positive. And when that is the case, investors get rewarded for owning stocks. When the 200-day moving average is rising, the annualized return is 7.4%, and 72% of the time it's higher, versus when it's falling, we actually see negative returns. And normally, when we do take the turn from falling into rising, like we did right here, we go on long extended rallies, like we did in the 90s, in early 2000s, and we took the turn very recently in the last couple of years after the 2022 technology crash, and we are probably going to move higher over the next couple of years in the S&P 500. And the recent price and breadth behavior is actually consistent with an ongoing bull market, except for one exception, which is global stocks above their 50-day moving average. This is not exhibiting bull market behavior, but everything else is indicative of a bull market, and you don't want to fight the trend. And we are starting to see global markets falter a little bit, and that mostly has to do with Europe, and that's because European earnings have mostly seen downgrades in recent months, especially since June, and that's because the economic problems in Europe tend to be systemic. We see stuff like Germany, which analysts are predicting to have a recession in the third and fourth quarter, and as a result, earnings estimates have come down in a very big way, and this has weighed on stocks overall. And when earnings come down, investors are going to go to stocks where earnings are actually growing, and that's going to be the Japanese market, the US market, and to some degree stuff like China with all the stimulus we're seeing. But looking at US stocks and the earnings we're seeing there, this is the percentage of companies beating consensus expectations for the third quarter so far. Take it with a grain of salt. Only 30 S&P 500 companies have reported so far, and a lot of the big names haven't. But what we are seeing is very strong early results. 73% of companies beating on EPS, 57% of companies beating on sales, 53% beating on EPS and sales. But guys, only 30 companies have reported. When we get to the 100, 150, 200 mark in the next couple of weeks, that's when we can really start to put weight on results like this. But let's switch gears and talk about Bitcoin, something a lot of you that have been requesting I do in recent weeks. And guys, looking at the median average return in Bitcoin, this is pretty much Bitcoin seasonality. From the middle of October, we tend to see Bitcoin do very, very well. We tend to see huge returns. And if we actually look at the seasonal cycle, that tends to be the case into the end of the year. Bitcoin tends to have strong returns from October into November and December into the end of the year. And so if you guys are looking to allocate towards high beta, higher risk, and you maybe don't want to go into small caps, maybe look at something like Bitcoin. We could really see huge outperformance in the currency over the next couple of months. And diving into the macro, this is the monthly change in the net percentage of fund managers expecting a stronger global economy in the next 12 months. And we have seen this very, very strong. Long story short, fund managers are expecting a stronger global economy in the next 12 months, above the 2 standard deviations. Last time we saw this type of sentiment was during the COVID period when the government was pumping a huge amount of money into the economy. Stimulus, we had rate cuts, not quite the same, but a similar type of environment going into easing, higher earnings, and consumers still in excellent shape. And we know what happened from 20 to 2021, the middle of 2021. It was one of the greatest rallies ever, except for maybe the tech bubble. Very strong returns ensued. And when you see this type of data, you want to hold on to the equities and stocks you have. And the current economic expansion cycle is still young. In 2020, we're sitting at 54 months. Normally, we can see upward of 100 months of economic expansion. And in 2001, we could see as low as 73. So at the very minimum, there's still still a couple of years in the economic growth cycle that we have right now, and there's plenty of ways that the market can still extract growth. One of them is through manufacturing, and rail freight carloads right now continue to rise, pointing to a manufacturing recovery. We do know that stuff like durable goods, the manufacturing market, and autos have been in a bit of a recession, and it's good to see them bounce back. And also diving into the consumer, household balance sheets are in excellent shape, at least according to the US, not so much in Australia and Canada. And when you look at it comparatively, the US is in great shape. Now, the reason why Canada and the US have such a high household debt to disposable income is mostly because the only asset that Australians and Canadians own is real estate. Coupled with housing prices being extremely high, that means they do have to lever up some more. And in Australia, at least, I know that banks virtually do not offer 30-year fixed mortgages. It's normally only 5 or 6 years. And when those adjustables have kicked in, that has resulted in a higher debt to disposable income. Countries like Toronto, Vancouver, Sydney, and Melbourne also have extremely high costs of living. And in Australia, at least, guys, the cultural norm is just to get a house. Home ownership is just like generally accepted, and people just take on debt to do it. And a huge proponent of Australian wealth and assets is in the household, which is not so much the case in America. And the last thing is that the same amount of income growth that the US has experienced, stuff like Canada and Australia haven't quite experienced the same level of income growth. That has resulted in a high debt to disposable income, not just in the last couple of years, but since the 2008 crash. I think the US market and the US consumer is in a much better position. And this is why I'm heavily allocated to US stocks. The fundamentals just make sense. Earnings tomorrow, guys, before the open, the two big ones people are going to look at is TSMC as well as Netflix. But we also have Intuitive Surgical. That's a big one. Infosys. And that's really it for Thursday. Then on Friday, we have American Express and PG, Ally Bank as well. But these two are the big ones. Looking at data for the rest of the week, there isn't really much. We had retail sales today, but we have building permits, housing starts on Friday. That's really it. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.